Welcome to Unit 1.2, where we will explore the various types of business entities. This is part 1 of our journey into understanding the different structures businesses can take. In this unit, we aim to analyze and apply the distinction between private and public sectors. Understanding these differences is crucial for comprehending how businesses operate within different frameworks. The private sector consists of businesses owned by individuals, while the public sector includes organizations set up and controlled by the government. The primary goal of public sector entities is not profit, but rather serving a specific purpose or providing a public service. The public sector exists because certain tasks cannot be entrusted to private businesses. These include essential services like military, highways, courts, and police. Additionally, the public sector ensures access to basic services for everyone and prevents monopolies in critical areas like power plants. The level of government involvement in the economy can vary greatly. In a free market, there is theoretically no government intervention, whereas command economies involve government planning of production. In reality, most economies fall somewhere in between these extremes. Public corporations are enterprises owned by the state, including airlines, energy companies, banks, telecommunications, and postal systems. These entities often balance social objectives with profit objectives. Privatization involves transferring tasks from the public sector to private companies. While this can lead to increased efficiency, it also means that private companies, driven by profit, may not always act in the best interest of citizens. A healthy relationship between the public and private sectors can lead to a better environment and increased tax revenue. This symbiotic relationship benefits both sectors and contributes to overall economic stability. Next, we will evaluate the main features of different types of organizations, including sole traders, partnerships, privately held companies, and publicly held companies. Each type has unique characteristics and advantages. The private sector legal structure includes various forms of business entities such as sole traders, partnerships, limited companies, and cooperatives. Understanding these structures is essential for navigating the business world. A sole proprietor is an individual who owns their own company. They may work alone or hire other people, and often these businesses are family-run. Setting up a sole proprietorship is straightforward. It involves registering with the government in the owner's name, sending in final accounts and tax payments, and printing the business name on all official documents. Sole proprietorships offer several advantages, including easy setup, being your own boss, flexible hours, no need to share profits, close contact with customers, and privacy in financial matters. However, sole proprietorships also come with disadvantages such as unlimited liability, difficulty in financing, multitasking challenges, hard to recruit employees, reliance on the owner, low economies of scale, and high stress levels. Partnerships involve 2 or more persons who share profits and contribute money to the business. Silent partners may contribute financially but do not participate in managing the business. Creating a legal agreement between partners is strongly advised. This agreement should outline the money given by each partner, their responsibilities, how profits are shared, and procedures for admitting new partners or withdrawing from the partnership. Partnerships offer advantages such as more finance options, specialization, and input on decisions. However, they also come with disadvantages like unlimited liability, less finance than corporations, longer decision-making processes, and potential difficulties if a partner leaves. Companies, whether private limited or public limited, are owned by shareholders who invest money in return for shares of stock. These companies are incorporated, meaning they are separate legal entities from their owners. Unlimited liability means that owners are personally responsible for all debts of the business. This can be risky, as poor decisions or bad luck can lead to significant financial losses. Limited liability protects shareholders from losing personal assets to cover company debts. Their loss is limited to the amount of their original investment, making it a safer option for investors. Limited companies can be categorized into 2 types, private limited and public limited. Each type has distinct characteristics and regulations that govern their operations. Privately limited companies sell shares to private family members and friends. The general public cannot buy shares on the exchange, and shares cannot be sold without other shareholders' permission. Owners have greater control but cannot raise as much capital as public limited companies. Publicly limited companies can advertise and sell shares to the general public through the stock exchange. This can lead to a dilution of control, as the majority of shares rule applies, and individuals or groups may attempt to take over the company. Flotation, or going public, occurs when a business first sells all or part of its business to external investors. After floating, the company is listed on the stock exchange, and this process is known as an initial public offering, IPO. Individuals buy shares to earn dividends, which are a share of the profits paid per share owned. Dividends can be paid in cash or additional shares of stock. Additionally, investors may buy shares for capital growth, selling them later for a gain. The board of directors is elected by shareholders to run the company and is responsible for strategic direction. Many board members are not employees and are not involved in day-to-day decisions. Limited companies offer advantages such as limited liability, the ability to raise large amounts of money through IPOs, continuity as a separate legal entity, and economies of scale in areas like specialization, marketing, purchasing, and technical operations. Despite their advantages, limited companies have disadvantages like financial information being open to the public, expensive setup costs, shared profits among many shareholders, double taxation, communication challenges, and threats from stock market takeovers. Limited companies are required to produce an annual report, including a balance sheet, income statement, and cash flow statement. These reports must be available to all shareholders and reviewed by auditors for accuracy and honesty. This table compares sole traders, partnerships, and limited companies across various features such as liability, double taxation, separation of ownership and control, economies of scale, and access to capital.